on here real quick. Damn out, right? But what I'm doing is actually delivering high value to the American people so that we can overcome this obstacle known as the collapse of society economically. Talk to my people, they're not going to be making much noise. So I wanted to, before they get started, I signed off. But look, what I wanted to go over here real quick is we can get back to this real quick. About 5 minutes, 10 minutes, we should be done. And take a look at this. So what it was the greenback, right? Here it says, make sure I got you on the screen here. Yeah, we good. So over the past year, it's saying that the greenback had appreciated against all the 15 major trading currencies, with the exception of the peso. So the peso stronger. So the dollar appreciated to its highest levels versus the yen since the 90s, which forced the Japanese Ministry of Finance to intervene in global capital markets to prevent the yen's further devaluation, right? Blah, 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 blah. So it gives you, it says, this stimulated calls for some corners of political spectrum and select investors to devalue the dollar, something that has not been attempted since the Plaza and Louvre, if I pronounced that correctly, in the mid to late 1980s. So this is important. That's why I wanted to make sure I signed back on and gave you this because I missed it. Attempts at talking down the dollar or outright intervention tend to be organized around narrowing the trade deficit, forcing domestically owned foreign manufacturing to return to the U.S. and competing for votes in the electorally rich Rust Belt. These efforts are no substitute for tackling more difficult problems like large government deficits in the U.S. or chronic underconsumption in China. So we know we had this issue where a lot of stuff left America, went to China, for example. These are the periods of time where they try to bring it back, of course, sell you the dream, get you to vote so that you can become property of the United States, right? But what it's saying is why intervention almost always fails. This is why it's so important that you understand why I'm delivering this cryptic message to you. And then you get your family, your people, your organizations, your community together. Call me for help if you need it. Send me an email. This is what I can help you with. This is why I talk about this sort of stuff, because it's what I'm focused on. And we can curb this so that it doesn't affect us the way it did historically, right? Which we know wasn't good. So the 5 decades since Richard Nixon ended in convertibility of dollars to gold in August of 71 have taught us that attempts to intervene in global foreign exchange markets have almost exclusively failed, they say. While central banks or finance ministries can intervene in global capital markets to support or depreciate a currency in the near term, it is difficult to sustain such action. See, this is why you hear me talk about sustainable communities. This is why you hear me talking about we need to get rid of currency, actually. You know what I mean? Because you can't have equality in the pursuit of equality, life, liberty, and the pursuit of happiness, right? In a currency-based system. It has to be free. This is why the irony is such that they call it a free market. They call it free enterprise, but then everything costs you something. You got to check yourself to ask yourself, why did they use the word free, but it's not free, right? Like if you went into the store and it said, buy one, get one free, but they said, well, you got to pay for 2, you would feel like something was wrong there, right? So anyway, moves to bloody in the nose of speculators or the stem outflows of capital short of more drastic actions like imposing capital controls or ending convertibility can work for a few days, weeks, or months, but they rarely result in significant structural change in currency valuation or capital flows, right? Basically, they don't last a long time. Now, here's the thing. It says, unless interventions by one government authority are supported by trading partners, central banks, and finance ministries, such actions cost a lot and have inconclusive outcomes. But here's where it gets dangerous. So recent reports by Bloomberg found that the Japanese monetary authorities bought over 50 billion in yen to stem the decline of the currency during the week of April 29th to May 3rd. So the action resulted in the appreciation of the yen from 160 to 152 against the dollar, with no guarantee of that level to be sustained. Now, foreign market exchange markets in the end are too large, with more than $6 trillion in chum, as they call churn, and with the dollar on one side of 90% of all transactions. In addition, it says the global market for U.S. Treasury bonds stands at roughly 31 trillion domestically and 36 trillion globally. Now, this does not include the roughly $13 trillion of private market assets under management, and the fact that approximately 30% of total capital flows in the immediate post-pandemic era are flowing into the United States. What does that mean? When taken together, the sheer size of these markets works against government interventions into foreign exchange. But that doesn't stop governments from trying. The confluence of economic and political events is now creating the conditions for another round of increased activity by nation states to engage in beggar-thy-neighbor policies. This is them, not me, but this says here, our analysts of global foreign exchange and capitals market strongly implies that an attempt to devalue the dollar will fail, and harm shall small and medium-sized firms that cannot obtain investment capital under such conditions. All right. So during the 1980s, developed economies were facing the perfect storm of currency weakness against the dollar when the U.S. monetary and expansionary fiscal policies moved in the dollar's favor. The Federal Reserve had jacked up short-term interest rates to 18% to slow inflation, while Reagan-era government spending and tax cuts were extremely expansive. Interest rates and growth in the rest of the world failed to keep up, which resulted in international investors flocking into the high returns on the U.S. assets, augmented by the dollar appreciation. Now, that all sounds good, right? But what it says here is all of the above resulted in a serious trade and economic imbalances that caused the American governing authority to engineer a coordinated attempt to devalue the dollar. Picture it like this. This is what I hear it saying. Let me know what you think in the comments below. All of this stuff causes reasons for everybody to jump into the dollar. The dollar goes up, people start spending, and then there's a massive collapse because all of a sudden everybody pulls out when the prices of the products are too high and it's not moving. Investors pull out at the peaks or what they feel like is a peak. Then all of a sudden there's a massive collapse, there's a massive run, and then you wind up in the Great Depression. There you go. It's that simple in 8 minutes. Maybe I should have done that first. I don't know. Check the other video for all the content of how we got to this point to make this part so simple. But yeah, consumer producer mindsets. More people become producers. We need the consumers to support them because you just see these imbalances. If they're left unchecked on our level, we're headed for self-destruction. Headed for self-destruction. All right? Pasha Paro, YNet7.